Hello everyone, welcome to the fourth episode of Finance Ke Funde. I am Shruti Agrawal.
I am Vikash.
Today we have somebody very interesting with us, and unlike our previous episodes, today we are going to speak to Rajeev. I would like Rajeev to introduce himself, and the focus of today's discussion is to understand whether FIRE, which is getting financially independent early in life, is a utopian concept. Is it achievable, and how can we really develop an approach to gain comfort and peace of mind when it comes to our financial journey? So Rajeev, over to you. We would love you to introduce yourself and also tell us how in your mid-30s did you one fine day decide that you want to quit the corporate life early?
Yeah. Hi. So I'm Rajeev Mohta. I started my career in financial markets back in 1994, and so I worked in mainly I've spent my time in fixed income markets. I worked in Indian companies. I've also worked in multinational companies. In terms of the decision to retire early, I love traveling. I love going to places and maybe spending a week maybe in a resort or in a hill station and those kind of things, which generally you can't do when you're in a corporate life. So then I realized that if I have to live that dream, whatever, or that aspiration, then something has to be done about it. Now, of course, you can retire and do it. You retire at 60 and do that, but then the thing is, you may not be physically fit enough to live that life. And for all you know, by then when you reach that point, maybe those things don't interest you that much. Things change. So that's when I was in my 30s, I realized that I need to plan a way, have a plan so that I can retire early. And so my target was to retire by 50. But then when I turned 50, something happened because of which I realized that okay, the day has to be pushed further. And by the time I turned 51, I was able to pull the trigger.
Nice.
So Rajeev, what does your typical day looks like now that you've retired?
So now, in my earlier life, I used to kind of wake up at 6, maybe go for a walk at 7, come back, be in the office by 8:30, and then work till 6 o'clock, and then come back home tired by 7, and then maybe if there's still some energy left, I used to go to the gym once in a while, maybe once in a week types, and otherwise normal watching television and food, dinner, and still go to sleep. Now things are very different, so I still wake up at around kind of 7 o'clock. I go for a walk. I walk for 1.5 hours. There's no time limit. If I find a friend walking with me, then I can walk for any number of hours, no problem. I come back, and then I have started to live my hobbies. So one of my hobbies was I love music. One of my hobbies was to learn guitar. That was my dream too for many years, but the corporate life never gave us sufficient time to learn those things, learn your dreams for that, live your dreams for that matter.
So you said that you could have retired early also, and something happened, and maybe you wanted to pull down your papers and you pulled down after 1 year. But do you think that if you could have done it 5 years earlier also, or this was the appropriate time when you could take this decision? How did you finally decide that this is the time where I'm comfortable and I can drop in my papers and pursue what I want?
So when this whole idea of an early retirement came to my mind, it was not age driven, it was corpus driven. So I thought that okay, once I have this kind of corpus, should be sufficient, and that's the time to retire. But then with the time, what happened is the way the costs went up, so cost of education, cost of healthcare and all those things went up, and I realized that maybe that corpus may not be sufficient.
Okay.
So then what is an ideal corpus? How do you decide a few years in advance that okay, that's an ideal corpus and all? Because once you cut closer, you realize, oh no, that's not enough. Then I realized I am getting to that cycle of just looking at corpus. Then I said, okay, let's put a time limit to it. And that's when I thought, okay, 50 I think should be a time when both in terms of corpus I would have reached a reasonable number, and that was the reason.
No, so why I'm asking this question, Rajiv, is that like in your case, I have also seen a video where you have discussed some numbers, but there are certain people who are at this age, okay, but they have certain liabilities and their corpuses, when I see some corpuses, that it is not enough. So why I'm asking this is that a lot of people want to retire early and they are at that age where they want to like leave this active employment, but the number that they have achieved till now is not sufficient. So whether you worked with a professional to understand that how will this corpus be managed in the next 20-30 years, you yourself did some Excel calculation. So how were you convinced that, yeah, at least see, because this is a very, very big decision at the end of the day, and if your financial situation is not solid enough or it's not enough, then you can, like, you have very big repercussions. So this is what I wanted to understand.
You see, since I had a fixed income background, I have spent all my time in fixed income. So we understand interest rates, we understand cash flows and those kind of things. We understand inflation. So what I did is I created an Excel sheet in which I said, okay, what are my normal expenses? What could be my emergency expenses as of now? And then even keeping a buffer, what if I have to retire today, how much money do I need on a monthly basis?
Okay.
So that's something which, and then what I did is then I extrapolated it for next 20-30 years. Then in that case, what I also did is I added inflation to this whole thing. And I was very conservative in terms of my computation. So I realized that my target was that my portfolio should give me a post-tax return of around 9%.
9%.
And with the assumption that inflation remains around 6%, I have a cushion of 3%.
Okay.
And that's something, and then I did a backward calculation as to what should be that corpus.
Okay.
So that's a corpus. The corpus is such that the return on the investments can ensure that I have a comfortable life. I don't need to compromise on my life in any manner. There is still some buffer as well. So, in the worst case scenario, if something happens and I realized we have not planned for it, what if interest rates go down to 0% or whatever?
Yeah.
What if equity crash? So we have done those, what we call it, shock analysis of the portfolio as well. And then I came up with that number. But you're right, I don't think everybody can do it.
Yeah.
There might be people from other markets, there might be people who are doctors, engineers, who may not have a financial background from that perspective. So they will definitely need help of professionals for that matter. And then professionals need to then come up with some kind of a calculator, the simulation and all those kind of things, so they can understand their client requirement and then accordingly make a plan for them.
So Rajiv, आपने बोला जैसे you were using an Excel sheet, you were putting down your expenses, you foresaw what kind of expense increase it will be, emergency funds, right? अभी मैं क्या देखती हूँ, like around me, बहुत बार आज जो हम सोच रहे हैं कि ये हमारे एक्सपेंस हैं या ये हमारी नीड्स हैं, थोड़े बहुत वांट्स हैं, एंड देन वी एक्सट्रापोलेट दैट इनटू द फ्यूचर, बट अ फ्यू इयर्स डाउन द लाइन वो वांट एंड नीड्स ही बदल जाती हैं, राइट? सो जस्ट बिफोर वी स्टार्टेड दिस वी वर टॉकिंग अबाउट size of the house and the conversations you have with with people in your family about the kind of houses they want to live in. So a lot of our clients, a lot of our friends, ऐसा होता है कि वो कहते हैं कि यार हम अभी एक 2 BHK ले लेते हैं because बॉम्बे में घर लेना इतना difficult है, let's buy this. But once they have a child, 2-3 years later, once a child is mobile, they start feeling it's very small. So that whole milestone changes. How does one continue to aim to retire by a certain time या certain corpus, जो भी आप एक लेते हो target, with आपके साथ भी, first of all, क्या आपके साथ भी ऐसा हुआ that some of your assumptions about your own expenses changed, right? And your family as well. And secondly, if such a thing happens, how does one align with this and still aim for FIRE?
So I think we are trying to do something like a shock analysis in the sense, what if situation changes? Now there are some situations which are in your control. the size of the house that I want to buy is in my control. I can have a 1200 square feet 3 BHK, I can have a 850 square feet 3 BHK, and that's something I can still control. There's something which I cannot, like child education. There was a time when I was flying all these things, the MBA fees at that time per year was about 4-5 lakhs. And by the time my kids would have gone, not that they've gone for MBA, but if they would have gone for MBA, today the cost is 20 lakhs. So now that is something which is not in my control. So the challenge happens there. Other things, I mean, I can decide to buy a 30 lakh car, or I can decide to buy a 15 lakh car or 12 lakh car. So as I said, if anybody thinks about an early retirement or planning for an early retirement, first is you have to control your behavior. You should not get swayed by what's happening around you. Just because your friends bought a BMW, should you also be buying one? I mean, at least I could control those things. Most of my friends have those kind of cars, but I'm fine, I'm comfortable in the car that I have.
So Rajiv, it is often said that a lot of what we do today is basis what we have in terms of data. आज के क्या circumstances हैं, वो सब देखकर हम plan करते हैं कि this is what we want, right? But actual outcome जो होता है, that is driven largely by two parameters: risk and your luck. In your case, how much do you think both these parameters have influenced where you are today?
So I would say, in my case, bad luck played a role, which eventually turned out to be a good thing. So let me tell you what happened. So back in 2003 or 4, I bought a house. So we were staying in a 1 BHK, and I realized that I've got 2 kids and they will grow eventually, so I need to move into a 2 BHK house. So I bought a house. And then, as usual, I mean, in Mumbai we have this regular issues around houses, projects getting stuck and this and that. So the project got stuck for some reason. But I needed a house, so then I ended up buying another house. And then the learning was that buy a ready possession house. So I bought a ready possession house. Now that was the 2-year period, around 2-year period, when I had 2 houses and I had 2 EMIs. So that was a difficult phase of life. But then the bad luck turned out to be good luck. The project got green light, and the pricing from 2003 or 4 was kind of the bottom for property market. From there it started skyrocketing. And then when I got the possession, I got very good rentals as well for a few years. And then when I sold it at 6x my purchase price. So that gave me a very good cushion. And in fact, that was the time which I would say was the trigger, saying that, okay, now my fire is possible, because there was a big chunk that I got. So I agree that luck does play a role, can play a role at times. In my case, bad luck played a role. But still, it will not happen with everybody, let's be fair. So the thing is, you still have to plan, you still have to look at your risk tolerance and then decide. So now risk again is, sometimes you have to take some extra risk. So suppose if my corpus is X and I know that it has to be 10X for me to retire. In that case, can I go and invest in a fixed deposit giving me 6%? The answer is no, that's not possible. That will not allow. So in that case, you will have to then figure out a different plan. Some of it can be an FD and the other has to be equities to give it that kind of returns.
So I have one question on this. So see, what happens is that you said that you had a real estate and you had to take another real estate. So in your early years, whether you were thinking on like asset allocation also was in your mind, that you were getting real estate heavy, or like a lot of your net worth is exposed to real estate. And also what happens is that with a lot of individuals, once they create any money in one asset class, they start parking another set of money again in real estate. So the money that you realized from real estate, did you again reinvest in real estate, or you took some other bet? And what was the thought process around allocation in various kind of assets and booking out gains and reinvesting? So how did you think about reinvesting in during those times? Because that was a big chunk of money you were saying.
Yeah, so in my case, I never thought of asset allocation or including real estate is a part of my asset allocation.
Okay.
Because the house which I had bought was for living.
Okay.
So I don't add the house in which I am staying as my asset.
Correct.
I mean, it's an asset, but it's for my living. And then when I bought the second house, it was out of compulsion. It was not like, oh, this is an investment for me, because I had to buy a house. But yes, when this house gave me 6x, at that time I realized I've got a big amount of money. Now what do I do with money? So then I realized, can I invest in another house which according to me is slightly lower priced, and then which can give me, so let's say something which is close to completion, like, so that's what I did. So I put that money in another house. Now that time it in a way it kind of became it was part of my investment portfolio.
Yeah, obviously.
So move it to that and then get some return there. And then when I did that, I realized, oh, then this can be done. So then again I invested in another house.
Okay.
So one house, the stuck house, then I made an investment in which I got some 30-40% return. Then another house, another 30-40% return. But then after that I realized, no, not anymore. I mean, sometimes, you have to realize that, okay, once you are now targeting this money as your retirement corpus, then at that time you can't take that kind of risk, because you end up then buying something and then it can be stuck forever. I mean, real estate is not so easy to, buy and sell. We know that.
Yeah, why I'm asking this question is because I also, I understand real estate, but the only problem that I feel is, let's say suppose you start with a corpus of 50 lakhs investing in real estate, it goes to 3 crores. Now, if you reinvest that entire 3 crore in another asset, that also has to appreciate, and you are taking a concentrated risk. So I wanted people to understand that how does concentrated risk play out, and if you don't take asset allocation call, then what happens is that your entire gains is again exposed to one particular house property which is defined by that locality and local regulations over there. So this is why I wanted to understand that how you are taking it forward right now.
So even in my case, when I sold this house, bought the other one, almost 30-35% I removed and put in fixed income.
Yeah.
Not that if I sold it for X amount, I did not put the whole X amount. It was like 60% went there.
Yeah.
The 40% I put in because 2013-14 was the time when, a lot of tax-free bonds were coming at 8.5%.
REC and PFC.
Yeah. So my portfolio is mostly HUDCO, REC, PFC, IRFC, all of it. So I put all that money in fixed income.
So as of today, your portfolio mix, I mean, do you still have real estate as an asset allocation in your portfolio, or is it all liquid now?
No, so I stay, the house, as I said, in which I am living, I don't consider it as a part of my portfolio. I have one small house which I had bought, it's somewhere in Palghar. But I don't consider that as it's a small house which is just there, which I'll probably liquidate whenever I want. But yes, in terms of how the portfolio mix looks like, it would probably be almost 70% fixed income, which also includes, let's say, provident funds. So it's provident fund, then there are bonds, then there are target maturity funds, and all those things wherein I'm literally not exposed to market risk. And then the balance, 25-27%, I think would be in equities, and 2-3% in gold and other stuff.
So see, what happens is, this is an interesting conversation. Why? I'll tell you, because in internet everything is flooded with equities, okay, and we are hearing that you have your corpus 75% in fixed income. So on that I have a couple of questions. So one thing with fixed income which a lot of at least I am worried is that you have some money in target maturity funds, but most of the target maturity funds that I can track are maybe maturing 2028, 2033. So this is maybe 7-8 years down the line. And you also mentioned that you have some investment in tax-free bonds, which again you invested in 2014. So most of the maturity will start kicking in 2023, 2024. These are 20-year bonds. Now in this case, what happens is, although you're not taking market risk, but interest risk is there in your portfolio. And we all know that the kind of environment we are in, a very, very high interest rate is generally not conducive for the government for growth. So the interest rates are generally they try to keep it at a check. So what is your views around that, and how do you think of interest rate risk in your debt portfolio?
Yeah, that's a good question, because when you go towards your retirement, generally your risk appetite goes down. And so you typically want to put money in more in fixed income kind of assets. And today, you may have 30-40 year bonds also, but the thing is, you don't want to put everything in those kind of bonds.
Yes.
So the question is, how do you diversify and ensure that your returns are protected? So for that, what I did is I invested in these insurance products.
Okay.
So what these products are that you pay for 5 years to 12 years, whatever. I mean, I have a mix of 5, 6, 10 and 12. So I will pay for that, and then after that, that gives me a guaranteed tax-free return for the next 12 years, 25 years, various kind of products. So by the time I turn 60, if I get a big amount as provident fund, proceeds from provident fund, and if interest rates come down significantly, during that period, this investment will ensure that there is a regular stream of cash flows.
Okay.
Which will happen, and these are like defined numbers.
Okay.
So I think we need to plan. People need to plan their investment in such a way that some bit of it is also towards risk management. I don't. So the returns on that portfolio would hardly be close to 6%.
Okay.
But then in fact, when I was doing that investment, my friends and all who are from insurance industry or who are again from financial markets says, but 6% is not enough, there are better options available. I said, yes, that's fine, but how do I know that when I turn 60 there will be a 6% bond available tax free?
Yeah.
I don't know.
Yeah.
So the thing is, why don't I put some money there?
Yeah.
So that so I look at that as a risk management product rather than a investment product.
Okay.
So what I sense is, even in your fixed income portfolio, you have done some category allocations, right?
Yes.
So there's an interest rate call that you have taken, like you rightly pointed out. Most of these products that we also analyze, which are guaranteed income products, are between 5 to 6%. And you've taken a call that, I will lock this interest rate for 10-15 years into the future, when probably the interest rates would be much lower in the economy, right? Apart from this asset allocation that you have done, what other products did you invest in? And your times could be very different, right? You would have planned like maybe 25 years ago, and when interest rate environment was very different in the country. But as of today, what does your mix in terms of other products look like? And do you also see any unforeseen risk in the allocation that you have as of today?
See, the unforeseen risk could be a very high inflationary environment. That's the only risk I can think about. My kids are grown up, so they
obviously
have their jobs, so they'll take care of their lives. Otherwise, I think most of the risks we can foresee have been factored in. So that's not a problem. But yes, one risk is still there will be chunky money which will come in by way of provident fund.
Yeah.
So still a very low interest rate environment is a big risk for me.
Yeah.
It's a risk for me. Not that everything has been locked in at 6% forever. So maybe that can take care of 20% of my expenses, 20-25% of my potential cash flows at that time, right? But the thing is, the balance is having that risk. So the thing is, there's some things we have to act only when the time comes. Because today I can't, even let's say if I want to buy a 40-year bond, which I can, but then I have to maybe sell or redeem my mutual fund portfolio of target maturity funds. If I do that, then my tax benefit goes away. Otherwise, I continue to earn my tax benefits on it. So it's a trade-off at some point. You have to take a decision at that point, because I think everything cannot be 100% foolproof. Some risks will always remain in your portfolio. It's only that you have to be very vigilant, and maybe every 6 months or 1 year down the line, look at the portfolio. If everything is fine, if there are some new sources of risk which have come up, then you have to think of how to manage them.
So right now your cash flows are funded by interest income, or they are funded by an SWP kind of mechanism where you are withdrawing part of your capital and part of the interest income?
So at this moment, from now to 2030, I have proceeds from my tax-free portfolio.
Yeah.
Some insurance is maturing, and some target plans are maturing. Actually, not now to 30, now to 30 to 2033. That's the way things are. So I don't need to withdraw any money. It's only when suddenly I realize that okay, some expenses come up, which I don't see, but if something comes up and suppose if I decide ki, okay, we'll spend another 20 lakhs staying somewhere for a month in the US or whatever, then maybe I may need to do some here and there, but otherwise every year I have sufficient money coming in which will take care of. And in fact, what I have also done is 2030 to 33 is probably the time when my kids will get married and all those kind of things. So my investment was such that in those years I get some chunky cash flows. So that's taken care of as well.
So, see, I am asking this question for the general benefit of the viewers, okay? So, and again, you are a fixed income guy. So, I wanted to understand your views around credit risk. So, generally what happens is that I, as an individual investor, I am generally wary of credit risk and I don't like taking credit risk. Like even slightest of credit risk, I don't feel good about it. So, there may be a yield which is higher, 1-2 percentage points, but I generally don't expose myself to credit risk. So, what are your views around credit risk in like fixed income instruments? And a follow-up, another question is that whether you are invested in NPS also, or whether you considered NPS also for your retirement kind of kitty?
So coming to credit risk, I am also a risk-averse person. In my career as a fixed income trader, I have only dealt in government securities and credit bonds. I think the lowest we would have traded was AA, but otherwise it's AAA, AA plus in that. So that thought has always been in my mind, not to take risk. And anyway, we are talking of a retirement corpus there. I would never want to take a risk beyond, let's say, a AA plus or something like that. I agree, nowadays a lot of these platforms have come wherein you get 10%, 12% on all those kind of things. I mean, to some extent, if somebody wants to take an exposure, it's fine. But I would, if that's the risk you want to run, I would rather say than go in equities. Why invest in those 10%, 12%? Because my sense is these companies, most of them are NBFCs. And then they will give all these micro loans and this loans and that loans, and you never know. And I don't think they are backed by very solid corporate houses. So in that situation, I personally would avoid taking that loan, and I would not recommend either. Some part of portfolio, if somebody wants to have it for fun of maybe some investment or something like that, maybe 5-10% you want to keep it, it's fine. But still, I would say do some credit analysis, look at those companies, constantly monitor those companies. Because see, conceptually it's still a new thing. All these things have started last 1-2 years only. You haven't seen a cycle. So it's better that keep the exposure as low as possible.
On that also, see what happens is on credit rating also, if you see 2018, a lot of AAA rated companies also defaulted. So because of that also, like I am like very wary that whether a person who is not well nuanced in fixed income should take that credit risk or not. And if you see a lot of retirees, I'm telling you, they say that I'm getting 2% higher, so I'll invest in this NBFC, and they're not aware about it. So this discussion I wanted to have with you.
No, so any additional money, any additional return which is coming is because of additional risk that you're taking. And maybe that risk is, the additional return is not commensurate with the risk that you are taking.
Exactly.
So just to give an example, like 2017-18 was Diwan Housing.
AAA rated.
Diwan always has been trading 1% higher than PFCRC, even though it was both were AAA rated. Now you need to understand, why are you getting that 1% extra? If other AAA rated people are able to raise at 8%, why is Diwan paying you 9%? That itself means that there is an inherent risk somewhere there which is not visible to everybody.
No, but I think, and I was telling Vikas a few days back about one of the cases. There was this elderly person I had met in Delhi when I was living there. And there is a lot of communication. The positioning of debt is about safety. Everybody, so within debt, different products, people feel that there is no risk as long as it is debt. Right, so just yesterday I was looking at a mutual fund portfolio. It had so many credit risk funds, and that other fellow that I'm talking about, he was advised by one of these bigger institutions, some bank or something, where he could get a 12-13% kind of an yield, from those products. So I think the awareness about risk for extra return is very low. So equity markets, because people are so aware, इतने news हैं, सब सुन रहे हैं, so people now know कि वहाँ तो risk है, but nobody is talking about risk in the debt market. So Rajiv, you also mentioned that you were always focusing a larger part of your portfolio in fixed income, and equity was something that you exposed yourself pretty late in life. Do you feel that that's a regret, or do you feel that that was a calculated decision that you took?
No, I mean.
Also, what was the reason for you getting into equity late?
No, so what happened is I did have, I had an SIP which I started back in 2005. So, but it was a very small amount. I mean, it was hardly 10,000 or 8,000 rupees a month. Ideally, I should, with my income increasing, I should have increased my allocation to these equity products, which I did not do. I mean, I thought this is enough. It's only when in 2014, when Modi government came into power, one of my friends, who now is the CEO of one of the mutual funds, I met him and he said, "What's your exposure to mutual funds?" And I said, to equities, and I said, I felt ashamed when saying कि 10% से भी कम है. He said 20-25% तो कम से कम है कि नहीं? I said नहीं, बहुत कम है. बोला immediately go and invest in equities. This is the time to be in equities. And that's when I then made a jump to put some money in equities.
See, when we work with younger people, like late 20s, early 30s, एक चीज़ हम देखते हैं कि जैसे बहुत सारे लोग हैं जो risk averse हैं, या they don't understand the risk and therefore they don't have an equity allocation, whether it is mutual funds, stocks, whatever. But क्या होता है अगर 2-3-4 साल उन्होंने luckily if they are also a part of bull market, for example in our client pool, people who started investing in mutual funds, let's say in 2018-19, and they stuck with their investments and उन्होंने 4-5 साल का bull market देख लिया है, so now they talk about their risk appetite very differently. So what we learned in our journey is that your risk appetite also evolves. तो अगर आपकी 5,000 की भी SIP थी और आपने देखा कि वो ग्रोथ आता है एंड IRR आता है एंड बिकॉज यू आर फ्रॉम अ फाइनेंशियल बैकग्राउंड वो नंबर्स आप समझते हो, सो व्हाई डिड योर रिस्क एपेटाइट नॉट इवॉल्व?
No, that's what I'm saying. It was a mistake. It was a mistake. I should have thought about it at that time. And that was the time when I also had that cushion of selling my house and I had that money. I should have probably taken some extra risk at that time. The only thing what was happening is that because of that, because we saw that global financial crisis and then suddenly everything coming down, then we had the credit crisis, again everything coming down. So the thing is, I realized that you will always, every 3-4 years, something will happen which nobody would have priced and again everything will come down. So that's why I was thinking, okay, let's then invest in fixed income only. But again, as I said, it was a regret. Maybe that standard rule which people say, your 100 minus your age should be your equity allocation. I think maybe that's a right yardstick to look at. I mean, I tell my kids that at this moment, at least 80-90% just put in equities.
Okay. So for your kids, you have this suggestion to them.
I suggest them. They decide what they want to do.
But you suggest them to go for a higher equity allocation in the initial years.
At this point, yes. Because it's not about timing, it's about timing.
Yeah. So, I think one of the key takeaways also is that, like say suppose in an insurance product, if you are blocking your capital for a fixed return, you are also letting go the upside. So one should not look out for both the things in any asset class.
Yeah.
So you cannot think that I will get the upside also and I'll not get risk also. I think this is one of the important message that anyone who is planning for retirement should think, that if you are trying to manage risk, you'll have to let go some of the upside also.
So they say ना, कभी किसी को मुकम्मल जहां नहीं मिलता, कभी जमीन तो
कभी आसमान नहीं मिलता.
So you have to, as I said, you have to balance that.
Yeah.
So so if I know that my target is to get a tax-free return of let's say 9%. So I know that okay, I've got an equity fixed income portfolio which is let's say giving me about 8% post-tax return. For that additional 1%, I can always do a backward calculation to say that, and realistically, if equity is going to give me 12% or 13%, how much of that allocation should be there in equity so that I get my target of 9%. So that's the way we looked at it, and that's the way I will constantly look for it. So suppose 1 year later, if I realize that okay, things have changed and my target now has to move from 9 to 10%, suppose, then in that case I have to then let go of some of the equity and then I'll take some risk. So for that upside, of course, it will come with the risk.
And I think you have mentioned again an important aspect over there. You also say, suppose you are a conservative investor. So what you have tried to do is that you have tried to reduce your equity exposure and not try to go 100% in debt. Because at the end of the day, you can, with a very, very low equity exposure, you can start beating inflation and your risk also reduces. So this is an important aspect that you have shared with us and for the larger audience, that if you want to reduce your risk, you need not always go to 0% kind of, you should not look at binary, you can always adjust your allocation in equity.
You have to balance it out.
Yeah.
Balance it out. Yeah.
I think one of the takeaway from your discussion is that it is very, very individual's decision to retire, and one has to think about other aspects, including finance, when you think about retirement, because there are other aspects also which should influence your decision than just your retirement corpus.
Yeah, I agree. It's a individual, but the only thing is, it shouldn't happen that now you want to retire and then you realize you don't have the corpus. So what I'm saying is, it's better that you keep thinking about it well in advance.
Yeah.
Okay, am I enjoying this life? Can I live this life for next, let's say, a corporate life? I'm not saying it's a bad life, but if at the age of 35, if you are excited enough to say that, okay, yes, I can live this life for another 20, 25 years, fine. At some point, 5 years later, or keep every 2-3 years, just think about it. Can I live this life for another 20 years? And everything is fine, you're growing well enough, it's fine. Because what happens is, suddenly for 5 years you are doing the same job and then you realize in a life tumne ko nahi rehni, and then you realize that tumhare paise bhi nahi hai. So the thing is, investments will always be good. Having a disciplined life will always be good. Because kal ko situation aati hai, you have something to take care of.
Yeah.
Or maybe take a break. एक साल के लिए break ले लो, 2 साल के लिए break ले लो, you have money.
So one more thing which is very close to me is health. Okay, so I see a lot of working professionals, because of their busy schedule, they are not able to focus on their health. So once you are out of this active corporate life, whether you have made any changes to your daily lifestyle which has had some impact on your health, or how do you see that shaping up for you?
See, I will put health in 3 parts.
Okay.
One is your physical health, the other one is your mental health, and the third one I would say is sleep.
Sleep, yeah.
I think all the 3 things are very, very important. If you just do one of it, it's not enough. Health, according to me, is not just going to the gym and enough, or maybe running.
Yeah.
You should also reduce your stress, and you should also have a good sleep. 7 to 8 hours of sleep is what. Now, for me, I'm able to, for now, I'm getting all the 3 things. I don't have a stress of work and all those things. I don't have a target to achieve and all those kind of things. So stress has reduced to a certain extent. The corporate life stress has reduced. Other stresses are there, but which anyway I'll deal with. That's fine. In terms of physical health, I can spend more time in walking. I don't have to think, oh, I have to go back to the office or whatever. So I walk 1.5 hours daily. I go to the gym 1.5, 2 hours daily. Almost alternative. One day I go for a walk, the other day I go for the gym. So I think I'm spending required amount of time even in the gym. And when you go and do this kind of exercise activities, you feel good the whole day. That okay, yes, I've done something.
Yeah.
It's not like I'm just retired and sitting at one place. And
obviously.
all those kind of things. And again, the third thing, sleep. I mean, I sleep at 11 o'clock and I wake up at 7 o'clock. So 8 hours of sleep. So I would say this is adding, good things to my health, I would say.
Yeah. One more question. So you now say, suppose you have retired, okay, and now what will happen is a lot of people around you would be coming up to you and would be asking you. This is general, they're intrigued, right? How you have retired, how you have thought about it. This conversation is also around that. But during these conversations, you will find 2 kind of people. One for whom financially it is possible to retire. One for whom financially it is not possible for retire. Even though if they are, say suppose they are not enjoying the job, they are in their early 50s, but for them it is not possible to retire because of their corpus that they have achieved till now, if their liabilities are higher. So specifically for people who are not having that kind of adequate financial corpus, whether you have dealt with any such person and you have guided them or you have tried to explain them, because sometimes for me it gets tough to explain people, right, that right now you cannot put down your papers. They say with this corpus also I'm not able to put, so kya corpus chahiye ki I can have a peaceful life. So whether you face some circumstances like this, and how do you deal with it, like how do you suggest people?
See, what I would say is that if you wish to retire now and you don't have enough corpus, then there's no other way. You'll have to either build that corpus, or maybe if you're already crossing 50, then maybe then you'll have to then again make some modifications in your behavior, your lifestyle, so that you continue to save, as well as you need to keep your expenses in check, so that when you retire, your lifestyle shouldn't change significantly. A little bit up and down is fine. So that's what I would say for those kind of people, because this may not be the best time also to take additional risk, because additional risk may even erode some of your corpus as well. So I would say maybe spend a little, invest a little more, and maybe keep your aspirations under a little check.
Yeah, why I'm discussing this, Rajiv, I'll explain categorically. See, what happens is that, say suppose somebody is having an X amount of corpus, okay, and if he thinks that he can generate 14-15% kind of on this corpus, he will be able to retire and he will be able to maintain his lifestyle. But taking such high number, like the return number, if it is very high on these lines on a retirement corpus, is not an adequate way. So that is why one needs to understand that if you are trying to live off your assets, your return expectations should be below 10%, so that you don't take such kind of risk, because once you retire, your risk appetite is already reduced, and if you're taking incremental risk on your investment portfolio, this is not suggested. So the idea is to give this message to people who are thinking about retirement, is that your retirement corpus should generally have a retirement return of less than 10%, is my view, so that you are not having any kind of sleepless nights and you're enjoying your retirement rather than thinking about your investment portfolio.
So in corporate life, we used to say when we were told that your target should be smart targets.
Yeah.
So it has to be realistic.
Yeah.
It has to be achievable.
Yeah.
And again, time bound as well.
Yes.
So the thing is, considering all those kind of things, yes, unrealistic expectations and unrealistic expectation even on your capabilities is incorrect.
Yeah.
Because you may think, oh, I can generate 14-15% return because that's what I did last year, but you never know. You are not the market. There's a market outside.
Yeah.
Right.
Yeah.
So and last 6 months, if anything has to be seen.
Yeah, see, but what happens in this, my view is that in the last 6 months, what has happened is, for a person who is accumulating, who is in an accumulation phase, he has still some money who he can put again and again, and he can ride it through 5-10 years also. But for a retiral, he has some cash flows that has to be taken out from the investment portfolio. So these two are completely different kind of risk appetite, and that message has to go to the larger audience.
Yeah, no, what I was trying to say is that what you have achieved in last, let's say 3-4 years, doesn't guarantee that you'll get the same performance
100%.
over next 5-10 years.
Yes.
Not possible.
Not possible.
In fact, even let's say even if my trailing 10-year return is, let's say, 14%, I will still not forecast a 14% return over next 10 years. I'll rather put it at 12%, 11%.
Yeah.
I have to keep some,
buffer.
exactly. Some unexpected situation can come.
100%.
Who knows?
Yeah. So see, what happens is that a lot of people retire at a certain age, okay, and they think that now I'm retired, I'll not do anything. But there is a certain set of people I have met that who have retired, but they have some skill set, and eventually after enjoying this phase for a couple of years, they have a relook. So you also have an open mind around this, that I would want to do something. Right now I am in an early age where I have just put in my work for just say 8 months. So how do you think about that?
No, so whatever capabilities that I have built over 3 decades of my career, I want to continue with that in a way that I am close to my networks.
Yeah.
And I continue to be productive even outside my house. So my intention is at some point maybe take up certain part-time assignments, something, let's say, which keeps me maybe 15 to 20 hours a week.
Yes.
Maybe half a day, 3-4 days or something like that, so that it kind of becomes a balance of, I'm not losing sight of the markets and all the other things, but at the same time I also enjoying my life, like my hobbies and all those kind of things. So that's the path I will take, maybe as and when the time comes, but I'm keeping myself open to that idea. It's not like I'm retired means like totally cut off from whatever I was doing.
I think that's a brilliant approach, because no one knows what is in future, and one should have an open mind.
Exactly. So in fact, one of my friends, when the markets were coming down, like the way the markets are, he's saying, if the markets continue like this for another 1 year, do you think you'll come back to markets for a full-time job? And I said, अभी तो वैसा horizon में नहीं है और मेरा portfolio भी वैसा नहीं है कि which will have this kind of shock. But for all you know, maybe some people have this kind of portfolios.
But for that, I think Rajiv, one should ensure that this does not happen because of portfolio, but maybe for other reasons. At least one should plan in such a way. But even if it is not happening for portfolio, one should have an open mind that if you want to do something, you should take up assignments which is not required for money at the end of the day.
Yes. Because it's also, see, job is not like job for me now. It's more like sometimes it can also be fun. It also be good to go out, meet people.
Yes.
So thank you, Rajiv. I think it was a brilliant discussion, especially because most of the time I and Vikas are talking about equity. So I think the fact that we got exposed to how you took certain conservative strategies and still you were able to achieve your goal was enlightening for us. And I think the underlying message which we really took away is that everybody is different. So all our milestones are very individualistic, and we hear about thumb rules in this course of financial journey. I don't think there are any thumb rules for anybody. So a couple of things that we take away from the discussion is that we need to prioritize what is most important to us. So if fire is most important, and if we want to exercise freedom of choice, then I think we need to keep certain things in check in terms of our behavior. We need to have certain visualization of what lifestyle keeps us happy and prevent that from kind of upgrading itself because the peer set lifestyle is different. That was one key takeaway. The second thing was that risk could be very different for different people, and everybody's risk appetite is different, and somebody who has a lower equity allocation does not necessarily mean they're doing it wrong, as long as they have a plan to make it work for themselves, right? And for people who are risk averse, and and I would like to tell this to the audience that even if you think that you are risk averse and like you lose sleep when the markets are volatile, you can actually adopt the whole asset allocation approach the way Rajiv mentioned about having a smaller equity allocation, a bigger allocation to asset classes which are not as volatile, and those asset classes could be different for people in our age versus when you were planning your investments. So I think that was a brilliant discussion. I'm sure that some people who are watching us today will be inspired and will move away from thinking that fire is impossible to start planning for fire at some point. And thank you so much for being here. We are totally honored by your presence today, and we look forward to having more such discussions with you.
Thank you for having me.
Thank you.